Alright, I think this is where we last left off, and this really is just a section on the completed contract method, which we've covered in class. The idea being that all the profit is recognized at the end of the deal when the contract is done. You accumulate the costs in the meantime in your inventory account. You accumulate all the costs in an inventory, and then you show the profit and take the cost out of inventory against costs of goods sold, basically, at that point, recognizing the revenue in the end of the deal. Next we have the proper accounting for losses. That's great. This is a new idea of telling us the proper accounting for losses rather than the improper losses, recording them properly. I'm making a joke. Okay, so what this is all about, here's what we're going to do here in this particular section. We're just going to ask you to get the basics of the theory. We're not going to get into numbers or journal entries of it. The theory is that on these long-term contracts, as you go along in a percentage of completion methodology, you may wind up seeing that you've over-recognized profit in prior years because of changes. Maybe the job's becoming less profitable, and because of that, in earlier years, you recognized too much profit. The adjustment is just a current period adjustment because this is under estimates. We don't go back. We don't show the current year as a loss or deliberately show it as a larger loss than it otherwise would be in order to make up the difference. We just go along and we adjust the current period so that between the current period and the prior periods, the total is about the same. I think I said that wrong. Let me restate that. What we do is we make the current period adjustment so that up to the new date, the gross profit is in agreement for all the years that we've been doing percentage of completion. So if that means we have to show a loss in a current year in order to make it work out with all the years, that would be fine under percentage of completion. Under an unprofitable contract where it looks like we're actually going to lose money, both methods will, meaning percentage of completion and the completed contract, will recognize the entire expected contract loss in the current period. This is just an adjustment where it's part of the adjustment is the over recognition of revenue in prior periods. An estimate, we just go from current on, and this is a recognition of basically like an impairment on the job. That's really what this is like. This job has been impaired. It happens in real life a lot. Contractors will get out on a job and they'll find something they didn't anticipate, or something else goes wrong, and the job gets impaired, and they're going to lose. They still have to finish the job under contracts many times, but they're going to do it, and they're just going to lose money by the time they finish. Now the management of that contract and that company, their battle is to just try to maintain the loss from getting out of hand. Tough business sometimes. A lot of money to be made, but tough business. Okay. So that is what I want to know there. Revenue recognition before delivery, disclosures, the construction contractors. This is, when they say this, by the way, that's referring to these long-term contracts. We're recognizing under percentage of completion the revenue as we go along prior to really the delivery being the finalization of the project. Okay, so that's so what we're talking about now is disclosures in the financial statement. We haven't spent a lot of time on notes to the financial statements because it's not really in the textbook. It's sort of as you go along. I think it would be good to give you like an overview of what goes into notes of financial statements, and I'll see if I have something I can put together for that. Nevertheless, the disclosures will show you what we're doing, percentage of completion, how do we do it, basis for recording inventory, estimates involved, what we call amount of backlog. This is very industry specific, and details about the receivables. I think this is beyond what I would expect you to know because of the detailed nature of the industry, but it's just good exposure to hear about it. in certain companies, completion of production, when they, even if they don't have a sale with a seller, they recognize the revenue because of the fact that the, I guess the way to describe it, the product is for sure going to yield a profit. It's not like you don't need to have a seller to know that you already have realized income because of the fact that you've completed the production. Precious metals is, I guess, a good example of that. And remember, these rules that we're learning now are very industry specific, and they've developed over a period of time, and so they become part of the rules of generally accepted accounting principles in that industry, so that all reporters of companies in that industry will be reporting on a comparative basis. So a lot of what you're seeing now may seem like going against the general principles of accounting we learned about, but there's an overriding principle of comparability that is causing us to stay within what might just seem sometimes to be against the grain, like they describes here. The realization of profit is virtually assured, so we as accountants go against our grain of conservatism in order to be comparable, and in order to recognize the reality that whatever it is, even though no sale has been made, the fact that the production was completed, the profit is then made. It matches certainly the profit against the expenditures and the time the expenditures are done with the production. I think the reason, you should check your textbook and check me on this, but I think the reason agricultural products fall into this category, I'm just taking a wild guess here, is because, well, one reason would be because people need to eat. That would be, they always need to eat, but the other reason would be is that many agricultural producers in the United States have government contracts or government subsidy programs which kick in as soon as they've met certain production goals. So they're assured of getting that even though they haven't quite gone to the government to sell the product or to use the subsidy. Okay, installment sales method of accounting. This is a good one. Let's go as far as we can in this before we're taking a break. The idea of revenue recognition after delivery is what this is about. So this is different. This is not completed contract or percentage of completion where we're particularly percentage of completion where we're recognizing it before delivery. This is after delivery. So it's the opposite of percentage completion. It's the sort of the polar opposite, where we're saying, okay, fine, we delivered the product, but we're not going to record the sale now. Let's just say opposite percentage completion. And so you're going to say, well, why? If the sale has been done, haven't we learned that that's the right time to record the sale? And yes, it is. And as we're going to see that there's got to be a reason when we're going to use this. And here it is. You've probably already noticed the language. When we're not reasonably assured that we're going to collect the sales price. So if we have this doubt as to whether we're going to collect, what we're going to do is we're going to say, okay, we'll hold off recognizing the revenue until we collect. That's really what we're going to do. And one way of doing that is what they call the installment sales method, where we recognize revenue in the periods of collection. Key on that. And when revenue comes in, you recognize both the revenue and the cost of the sales in a pro rata fashion. Notice that the selling and administrative expenses are not deferred. They're expensed in the period of the time. So they're expensed when they happen. It's just the gross profit that we're concerned about delaying with this installment method. And again, based on the doubt as to getting fully paid. And here you see a sort of a theoretical discussion that the profession, what profession? Well, certainly not the dental profession, it's the accounting profession, that this concept is not acceptable except in special circumstances. And by the way, one of the reasons why it's out there to be taught to you, even in a quick way hopefully, is that it is allowed in tax law. So it becomes a way of delaying revenue recognition under the tax code. So from that point of view, we like it as accountants. Okay, let's see how we work it. Let's see if I can find a quick way to show you what happens here. I'm not sure that I see exactly what I'd like to see here to make it easy. So let's take this example. Let's assume, I think this will work out okay. Maybe the circumstances of this example is not 100% on board with what I'd like to do, but let's look at it this way. Here's the initial sale. And instead of recording this to a revenue account, this really basically goes to a liability account. Reason being is we don't know whether we'll collect, and so it's not revenue yet. We'll recognize the revenue as we go along. So this is the total sale, and this is the deferred revenue, liability, and we'll say deferred. Sorry for this, the cursive script here. In fact, let me change that. So it's really like a deferred revenue account, or deferred sale. Let's see if they have language to it. Well, they're just calling it an installment sale, but it goes on the liability side. And further along, what happens is as we collect cash, that's the key, we're going to now reduce our receivables, but by every time we reduce our receivables, it kicks in recognition of a certain amount of revenue. So we bring in $60,000 of cash. This is the okay, so here it's pulling out, this is one more entry in preparation for the recognition of the revenue. They're pulling it out of inventory. That's okay because it's been sold. It's no longer in inventory, but it's being held not as cost of goods sold, and this is sort of an asset account, which I guess will become a contra asset account, or a contra account of some sort. And it probably goes, let's not say asset, just a contra account. And, okay. So here you see, perfect. So here you see, actually, we do it in one entry, but what they've done here is they've done it in several entries, which just makes it just easier for you to grasp onto what's going on. First, they set up the actual facts here. The first fact is the sale was for $200,000. We put it to an installment sale account, but that's going to get closed out here. Now we're closing it out, and we close it out to the contra account, cost of installment sale, and now we set up the deferred gross profit. So the actual amount of profit to be made on the sale, based on the facts that we know, is it's a 25% gross profit sale, and this is the amount that's deferred revenue, which will be recognized as we collect on the receivable. Remember, the receivable is set up here, right here, and as we collect, you'll see we're going to recognize the gross profit that's being deferred at this point. That makes sense. That's the right amount to defer. All right, let's see how it works. So, prepared. Why are they doing this? I don't know. Let's do it my way, which is, I think they said they collected $60,000. Let me show it. Let me show you the simplest way of looking at this. On the year of sale, if it's a $200,000 sale, this is getting a little bit longer than I hope to be, but we'll get it done. $200,000 sale, cost of the goods sold is going to be $150. Gross profit is $50. That's our gross profit, but we have a problem. We don't know if we're going to collect the $200,000, so we decided to use the installment method. What we're going to wind up doing is we're going to wind up setting up the gross profit as being deferred, and we'll wind up showing that deferral sort of in the following way. We'll set up a installment sale receivable, so let's call it installment sale AR for the $200,000. We'll take, and this is my composite way of looking at this, that's a debit. We'll have the inventory credited for the amount, which is $150,000. That's the credit. And then we'll have the deferred revenue. So I'll just label that as DEF, deferred revenue to $50,000. Keep those numbers in mind. Let's go to year 2. Let's see if we can find a space for year 2. Year 2, we start collecting cash. Now keep in mind that we took out of inventory what was sold, but we didn't recognize the revenue. We have put that aside and said, well, let's recognize the revenue when it comes in. So in the next year, let's say we collect $60,000 in cash. That'll go against the receivable that we set up, that's for sure. And now we say to ourselves, all right, what was the gross profit percentage? Gross profit percentage was 25%. So for every dollar cash, 25% of it represents gross profit that we're now collecting. So 25% of 60,000, that sounds like $15,000. That's good. And so we'll now reverse the deferred revenue by debiting it for the 15, and we'll put to our gross profit for the year. And it'll be called gross profit on installment sale or something like that to distinguish it from other kinds of transactions. And that's how, over time, each dollar of cash collected will recognize 25% of each dollar as being gain on that sale, but as we collect it. That's the deal. All right, let's see. They keep criticizing the installment sales method. I don't blame them. I'm not necessarily concerned about the criticism because we'll take it for tax purposes every day if we're allowed to. Again, that's the reason for that, in case you're missing, is the installment sale method delays the recognition of the profit until you collect. Unacceptable, basically in GAAP, all right, and we understand why. But there's good reason for using it in certain conditions. Okay. Let me see what else. All right, let's hold here, and we'll come back and finish the chapter up.